So let's look into our material so we can finish our stage one lecture and we know we are acquainted with some of the words because if we don't do that, you have problem understanding some terms or terminology. So okay, so I hope we're done with this for now. The next thing we want to look at for today, quickly, we move along. Okay, what are bullish and bearish markets? Remember, I have used one same word, but that same word can be used at different contextual meaning. I use buy. The other day we use the word long. I use the word up for same buy. So now we are going to look at this word also. We'll add it to your dictionary list. Those of you that have notebook. Now, do the same thing I'm saying. You have buy. We use this buy interchangeably. We also have long, depending on whenever, whichever one suits the grammar. The next you have is up, but up is always a local word, so we don't use up. Most of the time, we will use the market is either on a buy trend. I will tell you, I want to go or I want to go long. Then the next thing here is while you're seeing these keywords here, bullish and bearish, the next word you want to be adding to the dictionary is if you don't use buy, you use long. If you don't use long, you use up. It's the same thing. If you don't use up, you use bullish. It's the same thing. When I say the market is bullish, I mean that the market is on a buy. So take note, add that to your uh, dictionary list. So we are going to be using the market is bullish, the market is on a buy, the market is we are going long, or the market is supposed to go up. That means the market is supposed to buy. So let's quickly dissect these terms here. So the term bull, which stands for bullish, and bear, which stands for bearish, so are often used to describe how overall the financial market is performing in general. So whether there's an appreciation or a depreciation. So where you simply put a bull or a bullish market, we use it to describe a condition, is used to describe a condition where the market is rising. Okay. So whether you say the market is on a buy, whether you say the market is bullish, or whether you say the market is going long, or whether you say the market is going upward or is supposed to go up, it's still the same word. So depending on how you use it, but we need to educate you that whenever we use this term, they are professional terms. Whenever we use them, just know that is what we mean. So we have the next one called bear, which stands for, which is the full word is called bearish. So we'll tell you that the bears are in the market. That means we can tell you that the sellers are in the market. Like when we tell you the bulls are in the market, we're meaning that the buyers are actively in the market. That market will just close Euro USD. We saw that the bears were more in the market. That means the sellers were more and stronger, pushing the market downwards than instead of the market going upward. So bearish, we mean that the market is the one where the market is going down. The market is on a down direction, going in a down direction, downward direction. So it is not or a single day which describe if the market is bullish or bearish. So one day alone cannot tell you the market is bullish. So it takes a couple of weeks or months which tells us if the market is going to be bearish or is going to be bullish. So that is the characteristics of what you're going to describe that the market is either bearish or bullish. So what happened in a bull market? What is expected in a bull market? The confidence of the investor or the traders is high. So optimism, and a positive expectations. Someone want to join? All right. Okay. The, the optimism and the positive expectation that good results would continue. So in our bull market occurs when the economy is performing well. I give you an example of Euro USD. The market has been declining for months now, or 3 weeks now. Euro USD has been dropping. So it doesn't tell well that the European dollar economy or whichever one, it doesn't tell. Please, who is talking while I am talking? So it doesn't speak well of that economy, because why? When the economy is really good, you see that the market is going to be bouncing. It's going to be, you're going to see a lot of activity going on in that market. All right, so we don't want to spend a lot of time there. Read some of these things and let us move forward. So the next thing we want to educate ourselves. Let us now learn what a lot size is. So a lot size simply means a unit to measure the amount of the deal you place, your value of trades. Now, when you want to take trades, this has to do with your risk. When you see someone telling you, I am making $100,000 a day, I am making from $100 account, I am making $50 or I'm making $200, just know that from the lot size, it's where the person controls the risk. Either you're taking 10% of your risk, you're taking a whole lot of risk, and the more you expose your accounts to so much risk, the more you're exposing your capital. So when we preach Forex, we preach risk management first. We always tell you risk 1 to 2% of your account, of your investment. So when you risk more than, and then the market fails to play out, you know that you are going to lose so much. So where you are going to play around with your, you taking big from the market is going to be from the lot size. So let's read a little bit. So let us now learn what a lot size is. So a lot is a unit to measure the amount of the deal. So your value of your trade always correspond to an integer number of lots. So which is your lot size times your number of lots. So trading with proper position on lot size on each trade is key to successful trading. So the position size refers to how many lots. So what are the type of lot size we have? We have micro lot, we have mini lot, we have standard lot. I will explain in just a minute. So you take on a particular trade. Now we guide you. You don't just open any kind of lot size anyhow. You have to open based on the size of your account, so you don't blow your account up. So the standard size for a lot size is 100,000 units of base currency in a forex trade. So now we have a mini, micro, nano lot size that are whichever one you read up. But let us break this down. Before I will come down, I want to refer this also to another. I want to link us up to another material. Let's see if we can connect the other one here and then I'll come with an explanation. The way I'm saying, we may even end on the lot size for today. All right, so let's look at this material here. We want to pick out one of the sentences or the headings that talked about lot size. Lot size. All right, let's jump to here. So the lot size is the currency unit or the size of the order or the position executed in the trade. So in the stock market, the number of stock bought is calculated in shares like, oh no, this is not still giving us where we are going to. Now, let me give you an explanation on this. Now, the lot size is what you choose. Now, one thing about Forex is that before you are going into any trade, you decide your risk. We call it, what we call this kind of thing in trading, we call it risk to reward. Probably let's use the board. That will give us more of an edge to what we want to do. So in trading, we deal with what we call risk. So what? Risk to reward.
To reward.
So we don't risk $100. Okay, you have a $100 account. We don't come and risk the whole of $100 just to make $2. That is foolishness. The risk is not balanced. It's rather your risk to reward is taking 1 to 2% of your account in a trade. Then when you take 1 to 2% of your account, the reward must always be what? Bigger than your risk. Don't let your risk be bigger than your what? Your reward. It's not balanced. It's not a balanced trading. You're always going to blow your account or you're always going to lose much. So that means you are either risking $2 to make times 10 of this. So you are either risking $2 from a $100 account to make $20. This is a balanced risk. Or you're risking $2 to even make $5. It's still better. Or to make $10. So you don't come and risk $50 just to come and make what? $10 profit. It doesn't make sense. So we teach you how you get this kind of trading. How do you get this trading where your risk is lower and then your reward is much? So we teach you when we get to the advanced stage, we teach you how can you pick setup. Let's say Euro USD has been selling for 3 weeks. So imagine holding your position for 3 weeks. Now, someone will held Euro USD with a $100 account and was selling it since 3 weeks to now. The market has not come back to where you enter. Rather, it's still going like someone that left Abuja and has not come back to Abuja since last week. It's still going. That is how the market moves. So suppose you risk just $2 on your $100 account. Why we say you are risking $2? That means if your analysis plays out in risk to reward, it gives you in exchange, you are either going to be making, because if you are risking $2 for $100 and Euro USD has moved since what is it called? Since 3 weeks ago, your account should be in profit by now. Even with the least lot, you should be talking about $40 to $60 as a reward. Now, where was I going to? I was trying to let you know that we will teach you how you can pick setup that you take a smaller risk and then a bigger reward. So you don't take a bigger risk and a smaller reward. You're not going to make anything. So we teach you how you can look at those setups that can give you with the least risk and you get what? A higher pay. Now, that comes back to your lot sizes. Those that are professional will now come to where when you are professional, instead of trading 2% and wasting the signal, you see that this market is going to play out. Why do I waste 2% and be holding a trade to give me just, know that when you lower the risk too, you need to be expecting the market to move for you to make just $1. So imagine I am risking 0. This is how the lot size is. I'm risking 0.001 lot size. This market needs to move about 300 pips before I am getting even $5 to $3. This is the least lot, nano lot, but most brokers don't give you this kind of lot size. You have lot size from 0. 0.01. Now let's look at, we are into lot sizes. You have your lot size from 0.1 and you have lot size from 1.0 upwards. So now, remember, when you are a professional, you know what you're doing. So instead of risking 1 to 2%, we try to play around 10% risk. So that means if I have $100 account and I try to increase the risk to 10%, if the market goes in my direction, I am either risking $10 to make back what? Times 3 of this amount, which will be about $30. Which means if I'm risking $10, it means that if the market does not go my direction, I am going to lose what? Minus 10 from my $100. Then when you lose minus 10 from $100, what is left? $90. Still not bad. You still have what? $90 to, you still have 9 times inside of $90 to recover back your $10 and bring back the account to $100. That's what it means. That is if you are good. But if you start risking your account $50, if you start risking your account 50%, is a very bad, that your greed is too much. That means you are exposing, let's say someone has 1 million naira, and then you start risking 500,000 from your 1 million to go and take a trade. Now, it is 50-50 in every trade, it's probability. It's either the market go your direction or it comes back and hit your stop loss. We'll explain stop loss, what it means, what your stop losses does. So now that means if the market does not go your direction, you're risking 500K out of 1 million. If it comes to hit your stop loss, because you are risking 50%, sorry, that means you stand a chance of losing 500K from your account. Now, that is not even where I'm going to. That means if someone loses like 1 million from his account, you need what? To double the risk for you to recover your account back to 1 million if you risk 50%. Whereas if you risk 10% and your account is around 900,000, sorry, yeah, 900,000, that means you still have 9 chances to take trade, risking 100 what? 1,000, to make this account go back to what? 1 million. But when you carry the risk and go more than 50%, that means you need to what? Double the risk by times 2 for you to bring back this account to what? 1 million. So that is why we guide you on risk management. So the lot sizes is there to help you either what? By taking your risk lower or you take the risk higher, whichever one. I never, got to the States trading Forex, like where I am buying laptops, I'm setting up my trading room. I never got, reach up to this level trading smaller lot sizes. So preaching risk management and trading smaller lot sizes can never be what? Overemphasized. It's up to you. So you know what you're risking. So, but first of all, when we get further about investment, we'll teach you about Forex trading. Forex trading, normally we will tell you that when you're trading Forex, you don't take your serious funds that are tied to, let's say you're feeding money now, you take it and be trading. Or you are now taking your hospital money, you're taking your rent money, you're taking some kind of money. It's not good to use this kind of money because when you are trading, emotions begin to come in. Now, when the market is going to be struggling to, consolidate, you are in a drawdown. Let's say you fund $500. This is the whole money in your life. You have taken a trade. Since this is the whole money in your life, the market is struggling between minus 350 because when you were in a trade, the market was going minus 10, it was going minus 20. It was difficult for you to lose $20. Now, the market has gone all the way to minus 50. Do you want to close at minus 50 and lose almost all of your capital? How do you deal with this? That's why we tell you that you cut your losses short and let your wins be big. That is what we tell you. We motivate you in Forex. Some people like holding their losses. You have taken your trade. That's why we tell you in Forex, you must define your risk. What are you risking? You have $100. That is what you have to trade in the account. So the way of building $100 is always to what? Have a target risk. If you are risking $5 from $100, it's not a bad idea. You can, if $95 is left out of $100, you can always recover it. It's very easy. But when you leave from $100 to short $50, $40, even up to $30, you need high skills for you to what? Recover this money back to $100. So we tell you that when you are taking a trade, don't jump into a trade. Sit down, plan your trade. What am I risking? That means if this market I enter and this market does not give me what I want, at $5, I am out of this trade. I rest for the day until I see a good opportunity. I take again. Then now, by the time you leave your losses, I am risking $5. Something happened. Now the $5 has hit your losses. You are not in profit. Or you are close now. You refuse to close. Maybe it will pull back. Sometimes the market will pull back. We will try to hold and see whether it will pull back. But what if the market is not pulling back? Now, from $5, the losses go to $20. What will be left in the account? $80. Now, emotions start coming in. Your BP start going up because it's your last money. That's why we tell you, don't trade. Trade with money that you know that, yes, it's not your serious money. Because if this is your last money and then an account is standing at minus 20, it's $80. How many times do you need the market to move to blow this account? I don't know. But you know what is going to happen. So then it's easier to cut the losses when it is early, so that what? You have more leverage left for you to recover the account tomorrow. So the same way you are treating any business, in Forex, we have profit and loss. We don't only deal with profit. Some days the market can also hit you hard. But fine, your risk management is what is going to keep you. And then, well, ladies and gentlemen, I think at this junction, I want to stop the class at this point. So we continue. I am having a kind of engagement this week. So we are going to be looking forward to next week for us to continue with our series of lectures. But if I have the chance, the only thing we're going to do to cover up the remaining lot sizes tomorrow will just be, I'm supposed to be in a function. I'm supposed to attend a function by, tomorrow and Saturday, and I need to travel to you. So what I'm trying to say is, if I am there and the network is good, we might just finish up without coming on Zoom. That is where those people that don't have good network can enjoy the offline class on WhatsApp. And then I think that is that. Are we okay? We just have few persons participant on this place. So that is that for the night. Are we fine?
Yes, sir.
You can unmute your mic and so that is that.
Yes, sir.
Yeah. So if there is any question, please, the group is going to be open from now to 10. You can leave your question on the group, and I will always do well to respond to your questions. So right now, I have not finished up about I'm not finished explaining or letting you know much about the lot sizes, but I was taking my time to bring you to a real life scenario where the lot sizes can be understood. Yes, then we now match everything together. All right, thank you guys. Have a wonderful night. So if there's any question, like I said, leave it on the what is it called, on the group chat. So much later, I'm going to compile all these videos, and let you have them. So at your convenience or spare time, you can watch them, go over them. Thank you. Goodbye.